Okay, folks, welcome to Masterclass. I'm David Russell, VP of Market Intelligence at TradeStation. Great to be with everyone. Um, so I do this every other week, and I do the blog on the TradeStation website, and I do a lot of kind of looking at the market, some of the ideas we have in TradingView. And Jesus is really the expert at digging into the platform and showing you all kinds of ways to customize it and get the most out of it. And what I'm often looking to do is I've learned so much from people like him. And what I look to do is I look to actually figure out how we use the platform to assess the market, understand some of the things that are happening. I'm not an expert in the platform. I'm kind of someone like all of you. I try to be a power user who uses this for basically analyzing the market, looking for opportunities, trading a little bit here and there. So I want to just kind of show you some of the things I've been working on. I have some workspaces I'm going to share in a second, and some other stuff. You can view the disclosures here. There are a little bit of things with some ETFs and things that we have some disclosures that we can share with you if you're interested. I use ETFs for analytical purposes. Nothing I do is a recommendation, but I want to just show you some of the ways we can use the TradeStation platform to help us in everything we do. I no longer have to read these, so I'm going to just go ahead and move on now. All right, great to be with everyone. If you have any questions, please use the chat in Zoom. And I'm going to share some stuff with you guys. All right. So I have a series of zip files that have several workspaces in them. And this is one of them. Here's the ETF disclosure page if you want to see. There's also this workspace. This is the last Art of TradeStation I did, and it has a standardized disclosure page for ETFs. And here's another one I did on another masterclass. So I'm going to reconsolidate these and reorganize them soon. There's a lot of things out there, and I'm going to show you some more things that are interesting to me. We can just start by looking at the market overall. I've shared this with you guys. This is a workspace that I've been starting with. If you're not able to find it in the zip files I gave you, I'm going to give you an email. All right. Good question. Are you familiar with levels of add and a trend day? I'm not familiar with that exact terminology you're using. But let's see if maybe I touch on it based on some of the things I'm about to show you. Are these links to recreate workspaces in our own instance of TradeStation? Yes. All right. So if you guys, I see there's more people than usual. So let me just show you, if you open up some of these things, what you're going to see. If you open up, for example, the November 2021 zip file, you're going to see a series of ELDs, and then you're going to see a series of workspaces. You want to open the ELDs and import the studies. That would be the first thing you want to do. And then after that, you can open up the workspaces, and you'll start to see things that look like this. These workspaces. So, and then, so you just want to use the ELD files first, because these have custom studies like in range, multiple days, 21D. These are studies I created using easy language, and you want to make sure those are imported before you open the workspaces. Okay. Someone is asking about this. You have no sound. All right. So you folks, sorry if you're having sound trouble. I'm going to just type it. We're actually doing this from a different Zoom room than we have in the past. So I hope no one has any issues with that. Thanks, guys, for giving support to those other people. So let me show you some of the things I'm looking at in the market now. there's a workspace that I created. I'm going to show you guys. I'm pretty sure this is in one of the zip files I gave you. If it's not, then go ahead and tell me. So basically, this is one that I've been looking at and trading a little bit myself with. And basically, what I have here is I have 4 charts of the S&P 500. I have futures and I have the cash index. And what's interesting about this is that I think that we want to be looking, and what I have found useful is to look at the S&P on multiple time frames. All right, so this is here the cash index with hourly candles. This is like your true S&P 500 index, these two here. And what this is telling us is this is going to show us some really interesting sort of levels that, and we honestly had a roll today to the new month on the futures. I don't know if you guys noticed, but last night there was this weird jump in the ES because the platform flipped from, I guess it would be from December to the March contracts. I just let this stuff work on its own. So I don't really pay that much attention to the futures contract itself. I just take whatever the ES symbol gives me. And we have this because next week is expiration. It's a quad witching on Friday of next week. So we're going to flip over to the next front month futures. But anyway, I wanted to show you this because we have written many times on Market Insights and on TradingView about 39.10. And I have found this to be an extremely important level. It has dominated the S&P 500 in the second half of 2022. If you look back here, basically at the very late part of the first half in June, this level 39.10 was roughly resistance. Early July, it was resistance, then support. And then we had this huge failure here. And then this was, we tried to come down and hold it. We came back up and tested it, and then it was just pain. But then look what happened when we rallied back up to it, stalled, and then that big CPI number, we ripped through it and we held it several times since then. In my view, 39.10 is a pretty important level, and we're coming off of it today. So for me, it was important to see that level come back into play on the daily chart. The hourly chart, you can also see how this was pretty much, this was actually 39.10 pretty much right here, but this level has been important and we can see it kind of from this. Now, when we flip over to the hourly, the way that I look to use this includes a custom symbol called a custom indicator called MA speed. And what it does is it looks at the direction of the 50-hour moving average. When it's rising, this histogram here is going to be positive. So what's interesting here is you can see when here it is, it's rising, and you can see this is green down here. So my view of this is that generally what we want to be looking at are 3 to 4 different things on this chart. First of all, the main directional indicators are the 50-hour speed, MACD, and then stochastics. So this morning, we had stochastics overbought, which was bearish, and the 50-hour was falling, which was bearish. However, MACD was rising. And then there's another thing that pops up occasionally, which is outside candles. So we had a bullish outside candle here, and that's a bullish reversal pattern. So from my perspective, this gave an interesting sort of signal early today. The other thing I think is important is that an hourly chart is really not the most important thing. The daily really gives more signals. And like I had mentioned, we had the 39.10 on the daily. Another thing that's interesting, and I want to see if I can show you this, but the S&P fell for 5 straight days. There's only been a few times this year that we put together 5 consecutive downside days. I think there was one right here. There were 2, and both of them were followed by bounces. So the thing is that 5 days to the downside, and then it falls to a key level. The question is, does it have the bearish force to break support after 5 consecutive days of downside? Then the other question is, does it break support before next week, which is CPI on Tuesday, Fed on Wednesday? Those are major events. So, the risk to me more is that if it's going to break down, it's very often you're going to see it happen on the event. And so from my perspective, it's just interesting to see that we're holding these levels before the event. And that's kind of how I look at it. Now, the last thing I have here are the 4-hour candles of the S&P futures also. And what I find most interesting about this one is the rate of change. Excuse me. What's interesting here is we actually could see a kind of flattening of the rate of change. And what's interesting is that this is bearish divergence. We actually see our rate of change making a lower high as we make a higher high. This was a sell signal last week, and I think it's kind of interesting. So I wanted to kind of mention that. Now, of course, you look at other indicators. We also obviously have the 200-day simple moving average. I don't even have it on this chart. It's funny. I look at maybe 7 or 8 different charts I've made of the S&P 500. And this is my personal workspace. It's kind of a mess, but so but I wanted to show you, if you look at this, like the cash index, this is one I kind of look at all the time. And a lot of the stuff on here is just for some of the analysis I do for stories and stuff. It's not meant to be pretty, but we have the 200-day simple coming down pretty hard here. So that's just something to bear in mind. From my perspective, though, if we are going to break out, and I'm leaning more in the direction that we have upside from here, because you're not going to just take out the 200-day on the first time. I mean, that's a pretty high order of business to think that you're going to just go straight through the 200-day simple moving average without any kind of pause or any kind of tip of the hat or anything to it. The other thing here is, if we look, let me go back and put you on this. I'm going to go back and look at this on the daily. Nice clean chart. If I go to drawing, let's look at the whole calendar year. If you go to studies, then go to drawing, trend line. We can see here that there is this line that has been taking shape. So the question is, 39.10 is the second half support, trend line coming down, and we also have this gap from right here. This was a hot CPI number. So this is right here, I think, a pretty tight area that we're squeezing into. And I think people kind of should be aware of this. This is a potentially mega important area, 39.10 up to like 4,100. So it's a 200-point range that could kind of determine the direction of the market for significant, in an important way. So I think we need to just realize that this is a big thing here. This is very big. The downtrend and the bearish gap versus 39.10. And the other thing, actually, let me show you. I don't have it on this chart, but I have the 100-day simple moving average here. Now, honestly, in my view, I'm surprised more people do not use this tool, because the 100-day simple moving average, in my view, if you look at the direction that it follows, is it rising or falling, is a very reliable indicator of trend. The 200-day moving average is behind, but this gray line, the 100-day simple, it's now rising. It's not so much exactly like hitting it and hitting resistance, but you see here we ripped above it. Who cares? But what matters is it was still falling, and it dragged us down like a weight. But now it's rising, and we're also bouncing at it. So I think there are some other things on this chart that a lot of people are talking down here at 3,800, 3,750. From my perspective, they're missing some potential indicators much closer to where we are that I think are important. So I want to mention that. You did not get the zip file. I will share it again. Sorry, I'll tell you the one thing about some of this. It's hard to always have these. We have to do them in zip files, and we're actually working on a way to have it more organized. Here, just try these. Now, that was the thing I wanted to show you with the S&P. Let me see if I'm missing anything else. Let me see if I can actually quickly tell me if you guys have this, and I will share it, because maybe I should put together a new zip file. Email me if you cannot do this. Let me try and show you something right now. I'm going to go to create a new workspace. I'm going to go to new application, chart analysis. And I'm going to do, let's just do studies, add study. I have this thing called Price Streak. Trying to see if I can I created it on TradingView, and yeah, I don't think I have it. I think I have it. It might be as MA streak. Let me try this. So what this does is this actually shows how many days a moving average is rising or falling. I think if I set it to 1, it will actually show. Here we go. All right. So I'm pretty sure one of the zip files I gave you has this thing called MA Street chart. If it doesn't, please tell me and I'm going to give it. So anyway, this shows, well, 1-day moving average, which is basically the last price. This shows that we had 6-day declines twice this year. But if you look at all of history, you know, a decline much more than 5 days on the cash index is pretty rare. And you know, you have to be looking at something really massive like the coronavirus sell-off or this crash at the end of 2000, like this basically, this was at, what was this? This was right before the presidential election in 2016, when basically, like, and we see this before elections sometimes, like people just go to this, they just sit and they just wait. So anyway, I mean, you're looking at like, you know, a 5-day straight downside in the in price is just an aberration. So that's another thing I want to just point out, is that sometimes you actually see these things and it doesn't really matter the amount, it's simply the number of bars. It's another way to look at the market, and something that if you guys need, let me know, and I'm going to, I do have MA Street chart just added. Good. All right, so it's in the zip file if you guys got them. Now, what was the next thing I want to show you? There's so many things here that are important or potentially important. One of them, what I think is interesting to me, was we had that non-farm payrolls report last week with strong wages and the top line number that was strong. But what's interesting is this is the CME FedWatch tool, which I got to hand out the CME group, because this has now become like, you know, one of the coolest websites on the internet now, that shows, you know, the projected increases. But if you look back, you know, a week ago, and you look the projections for, say, the middle of next year, like say July of 2023, what you really see is that nothing has really changed here from a month ago or a week ago. We're pretty much, I mean, it's not like we added, you know, 50 or 75 basis points of terminal Fed funds. You know, this number was not that dramatic. So I think it's important just to realize that the market is really seeing us, you know, pretty much, it's pretty much seeing Fed funds go to about 5%, and that's it. And, you know, that basically means you got your 50 next week, which everyone expects. And then we still kind of have 25 after that, and 25. I mean, that's where the market is right now. And I think it's just worth remembering that we're going to get a new dot plot next week. Maybe, I mean, there's a chance they're going to add a little bit to the terminal, you know, rate. But you know, I just think that the market now is at a point where a lot of these things have been kind of you know, priced in. Let's look at this other article. Gasoline could go under $3. Well, that's interesting. Rent prices continue to fall. This was from something called RealPage. There was another very similar report from something called Apartment List. Where was it? I saw this other article. Apartmentlist.com. There's another thing that's kind of interesting if you want to look at this. If you Google apartment list as national rent data, they basically said that it fell 1% in November, the third straight month-over-month decline, and the largest single month drop. See, they only have 4 years of data, but still, it's something. So it's just interesting that some of these drivers of you know, the inflationary, you know, situation, they're showing signs of improvement. There was also the used car thing from Manheim that shows continued downside in used car pricing. So all these things continue to kind of point to gradual improvement. I did want to just mention that. Another thing, let's see if I can find this. If we go to Fed high yield spread, I've talked about this before, but what's interesting is this shows junk bond spreads. It's really not showing any real kind of recessionary trend. When this goes up, it basically, means that junk bond spreads are widening. You see it widening before a lot of recessions, and it's not widening now. So I think that's another thing that's important. I mean, to me, there's a lot of evidence here that a soft landing is, kind of what we're looking at. Now, the last webinar I was on, I was also speaking a lot about companies like Fluor, which to me were extremely important because these are some of these industrial companies that nobody talks about, but they kind of are gauges. And for some ways, they're kind of better than the transports. For whatever reason, transports have not been the most clear signal. But look at these companies like FLR. These are engineering firms. And these have all been kind of breaking out. It's pretty interesting to me to look at some of these names. So I wanted to mention that these companies are very interesting right now. They are not discussed as much as perhaps they should be. A lot of them have not had particularly good earnings, and they're going up anyway, and that's always an interesting signal. These are cyclical companies, and I think that's important. I also have been watching a new crop of companies that no one really talks about, but maybe they should be on people's radar. And this is like kind of the next generation of technology companies. You know what? Before I do that, I'm going to jump over. There's another workspace that I've recently created, and I've not shared this one, but I'm going to actually show you how to build it. But what I have here is I have 3 charts. I have a daily, a weekly, and I made the weekly blue so I wouldn't get confused, and an hourly. So what this does is they're all linked together. So if I look at a stock, I can quickly see in one view. I was tired. I actually found that I was making mistakes sometimes by not looking on the weekly. And I would just look at the daily, and then I'd be like, oh, wow, I missed something. And so forcing myself to look at the weekly has helped me. And so basically, this stock, CALX, is similar to Cisco Systems. And it's a very interesting chart. I think when you look at a name like this, it's had some interesting earnings. It's in this tight sort of range. This is one of these technology companies that doesn't seem to have this whole cloud computing, flu that a lot of the other stocks have. They seem to be involved in some of the levels of infrastructure investment that are happening now seems to be benefiting this company. Another one on my list is Arista Networks, ANET. This one also has a very interesting pullback here that is, to me, very interesting. Another one is Keysight Technology. Now, this company does testing equipment and like equipment that is used with 5G networks. Another interesting growth area. To me, these are interesting because these are all the kind of companies that are, you look at names like Apple and Tesla, and in some ways they're kind of dead money now. I think Apple has all kinds of problems. Not to say it's going to go down a lot. It's just, to me right now, going to be drifting. We know that there's the questions about China, the questions about their production and everything else. But I think the biggest problem overall is the fact that Apple's, just a well-known name, and it is also in a spot where it is not that cyclical. Like I said, I believe that we're setting up for an interesting situation of a soft landing of the Fed nearing the end of its cycle, significant bearishness baked in. And in an environment like that, a giant company that everyone knows is not necessarily where you're going to be looking for what is the growth for the next 5 years, because that is the view we want to have right now coming out of a bear market. We want to be, because very often there's a regime change during bear markets, and there will be new names that do well coming out of one bear market versus another, or at least one market pause versus another. I've talked about you look back, there was a big, back in like 2011, 2012, the market basically had it wasn't exactly a full-blown bear market, or I'm not even sure if it was a full-blown correction, but it had a period of weakness. And on the other side of that, basically commodities were dead, and the healthcare stocks led. And then in 2016, there was another long period of consolidation. And then on the other side of that, the FANG stocks led. So now coming out of this period, history suggests that we will not see the same kind of leadership. Tesla, Apple, Meta, these companies are now what people would call maybe source of funds. And people are, so that is my perspective. That's my base that I'm working with, my baseline assumption. And these are some of the things I'm going to be looking at, actually, my webinar this afternoon about finding leadership in new markets. So one of the things I'm going to look at in that webinar is, look for the stocks that are above the 200-day moving average. Here's the green line on my chart. Look at Apple. Here it is. It's under the 200-day. And now let's look at, CALX. Look at ANET. These stocks are above the 200-day moving average. The 50-day is above the 200-day moving average. So I wanted to kind of mention that. I also want to, there's two other names that are grabbing my attention. Sunrun. The solar just continues to be, I think, an area that people have to be, should be kind of thinking about. There's going to be attention on the ESG solar energy stuff for various reasons. I think when you look at it, I mean, I remember the early 90s, and we had a computer in our home, and I was, going into high school. I was in high school then, but I had a computer in the 80s, but if you walked into different offices, people didn't have computers still. I remember there were typewriters well through the 90s, but you always saw, why don't they have computers? And then guess what? By the end of the decade, everyone had PCs, the typewriters were gone. And I think when you look at a lot of areas, like probably all across the Sun Belt, Florida, Arizona, and then obviously if you go to Mexico, if you go to Africa, if you go to India, the potential for solar to spread is just significant. And I think that's, you don't have to be, a genius to see this. And so we're at the beginnings of what could be a pretty significant, growth. And to me, that's a fairly, that's a big thing we have to be thinking about. So one of those names is Sunrun. That to me today was interesting, the way it's pulling back here. This is one that I'm kind of been watching. And I'm going to get to the scans and stuff I've been doing for this recently. And then the other name that came up on one of my scans recently that I'll tell you nobody's talking about, but it's also just interesting, is CDW. I'm not sure exactly why this stock is doing so well. But again, this is another one of these kind of technology stocks that is very unglamorous. It's very B2B. And I think after, a lot of the stuff we've seen that has done well recently has all been, it's been the glamorous stuff, like the cloud stuff, and it's been B2C stuff like Apple, Google. These are not B2B stories. But then you dig in now, so a lot of these names that seem to be doing well are purely enterprise. They're names that you're not going to hear about, walking down the street. But that seems to be this next tier. A lot of these names have lower valuations. They're more hardware based. CDW popped up on my list because it recently had this golden cross, and it pulled back to the bottom of this Keltner channel here. I've been trying to do working with different Keltner channels, and this has two different Keltner channels, a tight one and a wide one, and it has a 21-day exponential moving average. So I've created a scan that looks for stocks where the 50 days above the 200-day, and then it recently had a touch or a pullback to the 21-day moving average. And that, for some reason, CDW popped up on this list, and it's just kind of interesting to see this golden cross happening on the chart. Again, Apple's below the 200-day, CDW is not, and price is truth. So let's look now at some of these other things I wanted to show you. So the way to create this, I know I'm jumping all over the place. Hope you can forgive me. What I'm going to show you here is what we do is, let's just create a new workspace. Now let's create chart analysis. I'm going to show you the beginnings of this. And then I can, most of these tools you guys have, go to chart analysis. And another one, chart analysis. And then I'm going to do a radar screen as well. Then I go to arrange. Good. Put them in the right order. So I want to make this one wise do now just to keep myself sane. First, I'm going to put them all the same symbol linking. Oops. What happened? Here we go. Let's just make them all like cyan. I'm not using that anywhere else. It'll be simple cyan. And I'm using local for this. I'm always experimenting with things to try and come up with ideas for you guys and for other things. I've been recently experimenting with having multiple desktops. So I've been using the global symbol linking. And what that allows me to do is it allows me to I have literally multiple screens, and I basically have my radar screen on one workspace and one of my monitors, and then it links over to the chart. So let's make this here just to keep ourselves from going crazy. Let's go to customize window. Let's go to color, and then we'll go to background. And I just change it to like just a kind of blue, and go like that. And now, I mean, that's just a quick thing I did. Now we know that one is weekly. But now here's the trick I came up with that I'm finding interesting about this. I did all right. So not just to save time, I'm going to show you what I did. So you'll notice on this chart of CDW, the green line is the 200-day moving average on the daily. I created it down here on the weekly. But what I did was I just this is a real kind of improvised thing to do, but it works. You basically say, what is 200 days in weekly? And it's basically 40. So what I did was I basically did my weekly using the same color, because 200 day for me is green. But then what I did to see the daily on the weekly chart, I used a different interval. And then what I did was by color coding it differently, it allowed me to know that that's always weekly. What I was doing before was I tried to do this, and then what I did was I would start messing around with the weekly, and before I knew it, I had somehow changed it to daily, and then I was having my green as a 40-day simple, and then that just caused trouble. So by keeping it in a workspace like this, I found this to be more useful. But I wanted to tell you that this works better for simple moving averages. Exponential is going to give you some trouble because exponential is difficult. I'm not sure mathematically how it would work to try and change the intervals. But with simple daily moving averages, a trick I'd come up with was to basically use this the kind of the analogous interval. So 50-day simple moving average is basically a 10-week. So I took the red here and I set that to 10. Just another sort of way that you guys can see. So, and then this is 10 on the weekly, and on here, it is set to 50. So it's just another kind of little trick I wanted to show you guys to help you kind of stay on top of things. Another pattern. All right, now I'm going to show you the one that really excited me. And this is, I have found that for equities, the 50 and the 100-day simple moving averages. Before I do that, I want to just mention, I know I'm all over the place here. I want to just tell you that to me, I think we need to look at the euro. I continue to watch. I have another screen that I'm watching here, but to me, it's interesting to look at the euro. I'm going to set this to hourly, but the euro here is, to me, in an interesting place. I still want to forget about this. I'm going to show you. Oops, bring this back. Window. Where'd it go? There it is. All right, let's make this. This is the weekly chart. Now I got to show this to you guys. Go to drawing, Fibonacci retracement, Fibonacci price retracement lines. Boom. Boom. All right, I know it's hard to see. I apologize. This is 50% right here, and we're at the 38%. I mean, here's a question. You know, do we only retrace to 38 or do we retrace to 50? I mean, my base case is more that, after a move like this, unless something goes horribly wrong in Europe, the situation here could favor, a deeper a higher rebound to the euro is basically what I'm saying. And if that happens, it's just hard to see significant collapse. And when I look at this now, I think, we have, to a certain extent, I do want to point that out. The 50% retracement to me is kind of a level I'm looking at when you consider the magnitude of this sell-off. Currencies don't really trend; they fluctuate, and there's way more mean reversion than real trends for the most part. I mean, you get obviously trends in currency markets, but the European currency is not going to be the Zimbabwe, the Zimbabwean dollar or something. It's just not going to collapse to that magnitude. It's going to come back to its mean. And I am not a currency expert, but I just look at this here, and this is kind of the target that I've had. And I think that when we look at this, the euro simply might need more, kind of mean reversion. I wanted to just kind of show that. All right, now let me go back over here to what I was looking at. Okay, hourly, the 50 and the 100 hour. I want to look at this one. I wrote this one for TradingView, DXCM. I wrote about this one recently on this pattern right here. So basically it had a breakout. It held this level at like 110, 109 perfectly. The 21-day came up and it bounced hard, and then it came up here. That's the daily. But now look on the hourly. What I have found is when this 50 crosses above the 100, it just gives interesting signals. And I have found many times I look for stocks and I buy them and I'm like, wow, that looks great. And then I get, bam, it goes against me. And I look and I realize, wow, I went the wrong way on this relationship. And I wanted to point that out. So the 50 and the 100 is a very interesting pattern. So this is on the hourly. Now, what does that tell us in terms of, how do we do that? Now, it's difficult to do this with Radar Screen because Radar Screen, there's ways you can do it if you get into some significant coding with object-oriented, with objects. But I want to just show you a way to do this with Scanner. So here's what I did, and I've been working on this recently. So I did this. What this does is, I'm going to show you guys how to do this. All right. So one of the tools I gave you, one of these workspaces, was MAX days since, MAX days since. And so basically what this does is, this will show us, once that red line goes under, it's going to start counting. And then when it crosses, it's going to start counting up, and then when it's under, it counts down. And this is a tool I created, honestly, of all the things I've ever done as a developer of technical tools. This is the one that I am probably most proud of, the MAX days since, because it really allows you to, I mean, I like it. I like MA streak as well, because I have found that, you actually get this of like the 10-day moving average on the S&P. When it rises more than 25 days straight, I mean, you have to just start being like realizing that you're in complacency zone. And you can do that with the MA streak tool that I gave you guys. And it doesn't apply to equities, but this other thing, you can see very often the moving average cross is most relevant. It kind of happens, it sits, and then the move happens. And this applies to a lot of things. I also have it here. It's set up as 2 MA ratio on this chart, which shows the 21-day versus the 8-day EMA versus the 21-day EMA, and it shows up as a ratio. So you can see here when it's red, it actually is showing that the 8-day is under. So as long as this line is positive, it's showing you that you have this kind of short-term bullish trend. It's kind of just like a green light, to have. Man, the euro is just blasting higher. I'm looking at it now. It's on my other computer. Anyway, let's, yeah, there were articles on Reuters about 3 weeks ago that said that the hedge funds were closing long dollar trades. I think it's important to realize that. I mean, currencies were so boring for, like, they were really exciting before 2008, 2011 period. They were totally dead from like 2011 through like this year. And now they've been incredibly exciting for trading. You know, the yen got annihilated this year, the dollar rallied, and now we're seeing movement in the currency market again. Currencies are starting to matter again, so we should have them back in our toolbox. Anyway, so let me just show you how to do this scan, and then I gotta go. All right, so what this does is you have this tool. You have this MA cross day sense in one of the zip files. There, sorry. I probably have I think I have too many workspaces open. All right, here we go. Let's go to the criteria. Let me show you this. This is seriously cool. And I have it set to run every morning now. All right, so what do I have here? This thing will automatically find, it's gonna find a billion in market cap, which is a market cap of 1,000,000, see 1,000. It's gonna be set to look for stocks that trade 500,000 shares a day. So that's right off the bat. Now, let's pop these things open and pay very close attention to all the settings. What do I have first? 50-day moving average above the 200-day. So notice this is set to daily and daily. It's set to 50 and 50. So, and it's greater than 50, greater than the 200-day moving average. Day being the key word. Next, MAX days since. Now, you guys have this. Now, you're going to notice when you load this tool, it's going to default to the 8 and 21 day exponential. You need to change it to simple and simple. Make sure you spell it correctly. Make sure you use quotation marks. And then I change it to 50 and 50. Now, the next thing is this is set to 60 minutes. All right, so this is going to use hourly bars and this is going to use daily bars. You're using multiple time frames in a single scan by doing this. So what we're saying is I want to find stocks with a 50-day, the red line is above the 200-day on this chart. But the other thing is on this chart, the cross occurred less than 20 hours ago. MA cross less than 20. Now, yesterday, Dexcom came up on my list. You can see here it's 22, but yesterday, this one, honestly, I am just annoyed at myself for not buying this stock yesterday because I was looking at it and it already, you know, I had written about it. I've been watching, and then we get the cross and I'm looking at it and I'm just like, oh, I don't know. What if we get a hot initial claims tomorrow? And I'm like, I'm worried, so I don't touch it. But then look at the signal that this gave, and there's other stocks that's been true for. But remember, here's the way you got to do it. Well, here's the way to consider thinking about doing things like this. The 50 is above the 200-day. That means you have a bullish longer term daily chart, and then the cross just happened on the hourly chart because it's less than 20. Now, this by itself will find bearish signals because it could be minus 20 and it would still show up here. So we need to add another criterion. This one, all right, let me just go back here. I'm going to shrink these down. This was the daily. This is the hourly bars cross threshold. So just to be clear, and a stock like CDW wouldn't appear on this because the 50's been over the 100 for a long time on CDW. So it would not appear on this, but let's just stick with this. All right, so now what I do, that's the MA cross day since. It says day since, but if you set it to hourly, it'll be hours since. Now, what I do here, I went back and I did a similar thing of 50 moving at the moving average versus moving average, but this time I'm doing 60-minute and 60 minutes, and I'm saying the 50-hour greater than the 100-hour. So the 50-hour moving average has to be greater than 100-hour moving average. So that will disqualify stocks where it is not. So if you look at some stock where it's not, I don't know, let's look at something. I mean, what's Apple? Let's take a look at Apple. All right, see, Apple's red. So a name like Apple would qualify, just to be very simple here. if you look on this criterion, it would qualify on days max, MAX days since is less than 20 on Apple, yes, but it is the red is the 50 is not above the 100, so therefore it would not appear on this scan. So I wanted to show you each of these steps. Then the last things I did was I said I want to have the last price greater than the 100 hour, because sometimes you'll find a stock where everything was bullish and then today it's like down a ton, and you don't want that. So you want it to be above the 100 hour. And then the other thing I wanted it to be was I wanted the price to be above the 50-day moving average. Occasionally you'll find strange things when a stock was bullish and then today it's down 30%. The moving averages didn't cross yet. But this approach, and you can create this with the tools that I've already given you guys. You could also say, I want to find stocks where maybe the 8-day is above the 21-day exponential. You can do that in here by going to, if you go to indicator, you go to moving average exponential right here, and then you just make sure you change the settings. You can go last versus that. So just so you realize you can do all that stuff. I wanted to just show this to you because this I have found to be a useful scan. I now set it, to run every morning. So let's see what it gave me this morning. It ran at 7 a.m. this morning. Let's just look in order of market cap. It gave that bingo. So DXCM was on the list this morning. I hadn't even looked. I saw it yesterday, and with today's price action, it's now 22. But this morning it would have been like less than that. LEGN. I don't even know what this thing is. Well, it's up. I never even heard. I don't even know what it is. Tempur-Pedic. That's interesting. I forgot all. This stock is an interesting one. Also, look at it. Tight. It's tight. And this is what I love about this setup. You can see here how it is against the summer. You can easily see some of these, the weekly and everything else, and it just crossed. So this is some interesting patterns. I'm just looking at these for the first time. Whoa. So this was some kind of merger or something that is, this is kind of just a bogus one. So you got to look at them because this company was apparently acquired or something like that. I mean, I don't even know what these companies are. You can also sort. So there's not a lot of signals on this one aside from Dexcom, and Tempur-Pedic actually looks kind of Sealy Tempur is kind of interesting. Anyway, those are some of the things I wanted to show you. Do you have an MA Street chart? Okay, I don't see any other questions coming up. So thank you for bearing with me as I jump around. I'm creating new things here. I didn't really cover the main workspaces that I have. But I think I showed you how to use the other one. And today I'm going to be doing a webinar that uses a lot of the similar tools in terms of analyzing with moving averages. One of the things I'll just end with is, let's just do a really simple thing. Go to Masterclass July 2021 and actually, I'm not sure I've actually given you. It's a very simple one. It's just distance from MA. Let me really fast. I'm going to just grab this for you guys because I don't like not giving it to you. This is my webinar this afternoon. I'm pretty sure you guys have all these things, but in case you don't. All right, this is the one I'm using this afternoon. One of the things I'm going to show people is basically look at the ETFs, and if it's above the 200-day, then that's good, and if it's below, then it's not so good. So I'm using this thing called distance from percent from MA, and basically I think I have it set to 50, but let's change it to 200. And you can basically see the ETFs that are above the 200-day moving average and below. So you have energy is above. I forgot to mention, energy to me here is, it just, there's some really weird things happening in energy. Probably have some interesting opportunities, at some point. I'm watching it. I don't really know what to make of it, but this just shows, look at, Meta, XLC is communications. XLY is basically Tesla and Amazon. You know, tech, these are under, but look at the industrials, you know, and like financials as well. They're above the 200-day moving average. So all of these things to me are, you know, some of the lines in the litmus test we want to kind of use to start kind of thinking about things. And I want to just share this with you. If you guys don't have, I'm going to just give you the code right now. And then I got to jump. Can you show the search criteria again, please? All right. I'll zip through it in 1 second. I'm going to give you this easy language code. Do you do fundamentals? You're just showing us how to identify ideas based on. So this time I'm not covering the fundamentals. I have given it in previous. Here's the code for this. I've given it in previous master classes. If you go to master class July 2021, I have my fundamentals grid where you can do a lot of this analysis. I've shown how to do a lot of scans on that. I have a webinar about doing fundamental analysis on TradeStation. In fact, if we go to, let's see, if you go to education and you go to platform, there is something here on fundamental analysis if you want to learn more. There, it's here somewhere under this. I have done it in the past. I think right now, you know, from my perspective, the fundamentals are less important than analyzing the sectors and the changing leadership. Very quickly going back over this scan. Okay, here we go. We want moving average line versus moving average line. 50-day simple versus 200-day simple. 50, 200, daily, daily. Then we want MAX day cents. We want to change it to 50 and 100, simple and simple, and change it to 60-minute candles for the interval. Then we want to do moving average one line, moving average simple, 50 versus 100, hourly versus hourly, 50 hour greater than the 100 hour. Then I also have the last greater than the 60 hour, the 100 hour. And then I also have the last greater than the 50-day simple. So remember, the key things about this are to use 50-day versus 50-day. Make sure you're looking at daily and not hourly. Make sure you have the daily and hourly correct. Do the MA cross day since, and you want to do that one based on simple, simple, and hourly. And then you want that's going to give you everything, including bad stuff. So then you want to use this next one, which is basically 50 versus 100 hourly to get rid of the bad stuff. So that'll eliminate the stuff where the 50 hours under the 100 hour. All right, folks, it's great talking to you. drussell@tradestation.com. Please feel free to email me if you have more questions. I'll see you again soon. Don't forget we have the webinar today. Hope to see all you guys then, and have a great day.